take a look now at Berkshire Hathaway's acquisition criteria, because I think to do so is extremely instructive. For many years, Warren Buffett has solicited interest from people wishing to sell their businesses by making his criteria public, including in his letters to shareholders. And note as we go through this, the sellers need to meet all the criteria. Now, the first really smart thing about this is he's not going out there bidding for businesses. He's waiting for people to come to him and therefore putting himself in an extremely strong negotiating position. Although you'll see from the way he handles everything, his approach is extremely fair. The first thing is that he's particularly in the current Berkshire Hathaway as it is today, they're looking for very large purchases, at least $75 million of pre-tax earnings. And they want to fit the businesses into the existing structure of the organization, essentially as bolt-on deals. Now, one of the key points here is when you go back far enough, you'll see that the original pre-tax earnings level, I think, was about $5 million. So you can see how over time the amount of pre-tax earnings has steadily gone up as Berkshire Hathaway has grown. Point 2 is you must demonstrate or be able to demonstrate consistent earning power. He's not interested in future projections or in turnaround situations. So he wants a very strong historic track record, a well-run, well-established business. He's also noted not interested in investment bankers' projections, about which we already know he has very firm views. Businesses earning good returns on equity while employing little or no debt. There is no interest here in EPS numbers, which he knows can be manipulated. He is focused on shareholder returns, nor is he interested in leverage, as we've already seen. Point 4, management in place. This is absolutely critical. He wants to buy businesses with good managers in situ. As he says, we can't supply it. But instead of replacing managers, which so often is the case, he wants to buy businesses and retain good management who already know the business inside out, who already know how to run it well. And this is a critical factor in the success of this approach. He wants simple businesses. If there's lots of technology, we won't understand it. Both Buffett and Munger want to stay within their circle of competence, a key Benjamin Graham criteria from The Intelligent Investor. Invest in what you understand. Now, this one's really important. An offering price. We don't want to waste our time or that of the seller by talking, even preliminary, about a transaction when price is unknown. Note, no auctions. We'll come on to mention that. And Buffett has no interest in bidding for businesses. Now, I read an excellent biography of Buffett by Alice Schroeder called The Snowball. And in that, it's very apparent that if I'm a vendor and I come to Buffett, I've got one shot at offering him price for my business. And if he doesn't think it's reasonable, then he says, no, thank you very much, and I can't come back. If you try to game him on this, you lose his trust and it's game over before the discussion has started. He absolutely doesn't give second chances on this. He wants to do businesses. He wants to buy good businesses at a fair price with people he can trust. Now, there are a few more important caveats. The larger the company, the greater will be their interest. He's trying to deploy vast amounts of money. We're not interested in receiving suggestions about purchases we might make in the general stock market. He can do that for himself. We will not engage in unfriendly takeovers. Critical, he wants to work with managers and have them as partners in his business. We can promise complete confidentiality and a very fast answer. There's no advisors. There's no committees. Customarily within 5 minutes as to whether we're interested. You talk to Buffett, you get an answer. Now, he says we prefer to buy for cash, which we know is very important because he doesn't like to dilute shareholders and he has a lot of cash. He will consider issuing stock when they receive as much intrinsic business value as we give, which is a really important caveat. He doesn't go for making deals with his highly rated paper if it's going to destroy value for shareholders. We don't participate in auctions. Enough said. He also goes on to say, Charlie and I frequently get approached about acquisitions that don't come close to meeting our tests. We found that if you advertise an interest in buying Collies, and by the way, Mr. Buffett, we have a border collie, but I'm sorry he's not for sale. A lot of people will call hoping to sell you their Cocker Spaniels. And in his usual Midwestern folksy way, he comes up with a great little line here. He says, "A line from a country song expresses our feeling about new ventures, turnarounds and auction-like sales. When the phone don't ring, you'll know it's me." And I think that sums it up really well. Now, the critical point here is you have to meet all of the criteria that he set out. But with this approach, Buffett avoids overpaying, does deals principal to principal, and gets to do a business with people that he gets to know, importantly like and trust. He takes a partnership acquisition to M&A, to acquisitions, with respect on both sides, and he's looking for a long-term partnership. He's not looking to flip these. He doesn't sell these businesses that they acquire. So it's a very, very different approach. In my view, it's about as far away from market practice as you can imagine. And of course, it works. So that's a summary of his acquisition criteria. If you're an advisor or if you're a principal and you're looking to get into the acquisitions market, then you could do very much worse than adopting many or indeed all of these criteria for your own approach to acquisitions. And maybe it'll keep you out of the very large majority of people who do bad deals.